Is the all-encompassing asset bubble about to burst? We've seen Bitcoin drop nearly 60%. We've seen the stock market drop 20%, and everyone's looking at housing, saying that housing is next. Well, in today's video, I want to spend a little bit of time and compare housing to, say, the stock market, why the two aren't different. I think we can all agree that what the Fed has done over the last 2 years has definitely created some bubbles. They've inflated prices in the stock market. We have companies trading at 100 times the valuation. We have Bitcoin that was trading over 60,000 that essentially is just made up. And we've got house prices selling, in some markets 40, 50% more than they were just 2 years ago. So when you look at that, you think absolutely it's a bubble, it has to pop. Well, I want to spend a little bit of time and talk about the idea of inflated prices and why housing isn't similar to the stock market and why you're likely to see some slowdown in house price growth, some deceleration, but it's not likely to lead to a housing crash. So over the last 2 years, we saw the Fed pump nearly $5 billion of stimulus money into the economy. At the same time, they were buying $120 billion per month in mortgage-backed securities and treasuries, which artificially brought interest rates down, which created this storm, if you will. We headed into 2020 with low inventory already out there, and then you added some fuel on that fire by lowering interest rates, the Fed funds rates down to 0. That brought interest rates down to 3%, even under 3% for many well-qualified buyers out there. And so there was a frenzy, if you will, of people looking to purchase property because money was cheap. At the same time, businesses were out there borrowing money because it was essentially free. And this created the inflation that we're seeing now on top of the supply constraints that were created because of how much money people had, the supply constraints and the bottlenecks that are out there because all of this money came to the market at one time. Imagine sitting in your home, not being able to spend your regular paycheck, and then getting cash dropped in your mailbox by the Fed. And then as the pandemic eased, you were able to actually go out and spend money. And many companies out there had stopped producing some goods because of how difficult it was to navigate that world with workers and COVID and the pandemic and things spreading. And that created, issues with regards to supply. And then so all of this money infused into the market and there were limited number of goods to buy and people went out and spent that money and it created additional bottlenecks in the market. And that's why we saw inflation numbers rise. So right now we're sitting at a CPI around 9.1%. And on top of that, we have people looking at the stock market going, the stock market's dropped 20%, Bitcoin's getting hammered, the housing market has to be next. So right now I want to spend a little bit of time and talk about why the two are different. And then we'll talk about some similarities between, say, the stock market and the housing market. Now, before we dive into this, I'd like to ask a favor. If you find any value at all, hit that thumbs up. Feel free to subscribe to the channel to stay updated on everything real estate related. Now, the biggest difference between, say, the stock market and the housing market is the idea of transaction cost. What am I talking about? Well, as the economy starts to slow, people see the stock market starting to decline, it's really easy to go in and sell that stock. With all the online platforms out there at the moment, many of them are really, really cheap with regards to transaction fees. Some you can trade a stock for zero money at all. It's really easy to go in there and push the sell button and sell that stock. And at the same time, once you sell that stock, there's no need to go out and buy another stock. Your family doesn't need stock to live, but they do need shelter to live. And the transaction cost to sell a property is substantially higher than selling a stock. Like we mentioned, sell a stock, $7, $10, free in some cases. To sell a home, you're looking at somewhere between 5, 6, 7% of the purchase price to sell that property. On top of that, when you sell that property, in many cases, you have to find somewhere else to live. And many of the sellers out there are also buyers. So in order to buy another home, it's going to cost you another 2 to 3% with regards to closing costs and prepaids and what have you on the loan side. So the idea of selling a property is much more expensive than selling a stock. So as stock prices declined, people start getting emotional in many ways. They're looking at the inflation numbers, they're reading the headlines out there about everything crashing, and they decide to sell, which continues to drive prices down. Whereas homes are a little bit different. Homes are necessary. You have to have shelter in order to live. And because of these transaction costs, when home prices move sideways, they decelerate, in some markets they decline, you have less people jumping on the bandwagon to sell unless they absolutely have to, because it's so much more expensive. Now, as I mentioned earlier in the video, I do believe that prices are somewhat inflated on the housing side. Some could say they're really inflated. Some might say they're not inflated at all, but I do believe prices are inflated because of the super low interest rates that, the Fed gave us by lowering the Fed funds rate and continuing to purchase $120 billion in mortgage-backed securities and bonds for such an extended period of time. That drove rates down, which allowed house prices to continue to go up at such a rapid pace. Now, with that being said, that doesn't mean house prices have to decline back to where they were before. In fact, it doesn't mean they have to decline at all. House prices can move sideways. They can go up by 1 or 2% for the next 5 to 10 years and get back in line with the long-term trend in real estate over a 65-year period, which is somewhere between 4 and 5% appreciation. Because we've seen, rapid appreciation over the last 2 years, 35, 40% in many markets, you actually need house prices to pull back, to stabilize, to maybe go down a little bit in some markets in order to get house prices back to that trend. So I want you to understand that just because the stock market's declining, just because your Bitcoin is going down, doesn't mean house prices have to follow. Now, earlier in the video, I did mention that there are some similarities, say, between the stock market and the housing market. The first is the idea of emotion. When somebody buys or sells real estate, there's some emotion involved in that process, right? Because it's your home, it's where you live. In many cases, it's where you raised your kids. There is emotion involved in the sale of that property. Secondly, with regards to stocks are also emotional. Now, you might not think they're emotional, but when you buy a stock and the stock price declines by 20%, you choosing to hold on to that stock even though it's declined 20% is an emotional thing, right? You not wanting to let go of it because the price has declined and you wanting to get the price that you paid for it. That's emotional in part of that process, right? Because you're not willing to come to grips that the prices have declined. The same with a house, right? If your house price declines and you paid, say, $500,000 for it, and now it's worth $475,000, many sellers out there are going to stay put. Why? Because of the transaction costs that we mentioned earlier, the cost to sell that property. Now, this is assuming they don't have to sell this property for any reason, but sellers are going to keep that property. Why? Because they saw their neighbor's house sell at $500,000 and it's emotional to them. They don't want to let it go for less than their neighbor's house because they believe their house is nicer. Their house is in a better location. Therefore, sellers are going to continue to stay in those homes and not put them on the market. Which brings me into the second similarity, and that's that prices are sticky to the upside because there's that emotion with regards to selling a house and not wanting to let it go, for less than you think it's worth or less than you saw the value at one time. That keeps prices high because sellers aren't willing to let it go for any less than they know or think that it's worth. And the same with stocks, right? That's why people hold on to them. They buy them at, say, $60 a share. It goes down to $40 a share. They say, no, I paid $60 for that. I'm not going to take that loss. It's only a paper loss. It's not a real loss. I'm holding on to it until the value comes back. And once that value comes back, people bail out or they keep it and continue to hold on to it. So it's emotion. Prices are sticky to the upside. But at the end of the day, the two don't really follow each other. So if you're someone sitting out there waiting for this big crash to happen because, asset prices are declining in other areas, don't think that that has to happen to real estate. Can it happen? Sure it can, but you need more of a black swan event to take place to drive down house prices than something happening in these other areas. So just pay attention to the information around you. Make sure you understand it. Read between the lines. Don't just read the headlines. But there is a really good chance that we are going to see a recession within the next year. If you're looking at that and you're worried again about house prices, how to prepare, do me a favor, check out this video here. I dive into it in more detail. But for now, I appreciate you taking the time to watch. I appreciate the support. Hope to see you again soon. Have a great day. Bye-bye.